Hey everyone, this is Caleb Franzen with Cubic Analytics, and I wanted to put together this video today to analyze and discuss two different market studies that I've recently shared on Twitter. And I think both of these are so important because they're actually showing conflicting directions and market trends. So right now, I really think it's up to each individual investor to analyze the broader market environment, look at these two different studies, and really get a sense for which way they believe markets will develop. So for me personally, I always like to start with the bad news first so we can end on a high note. So let's go ahead and dive straight into the first bad news data that I generally have. So quick backstory on this. I think a lot of people across the market, whether we're talking about the crypto markets or the stock market, are really talking about how it's very possible that we're already in a recession right now. Therefore, the bottom of each of these markets could already be in, and markets are just going to continue to celebrate and rally higher from here. However, one big deterrent or disagreement that I would have with that point is that we haven't seen a traditional deterioration in the labor market that would be congruent with a recession. So typically when we have a recession, we're going to see a massive uptick in either the unemployment rate and or the total amount of people who are unemployed, which is referred to as the U6 unemployment. And so what I ended up doing was looking at a study, and I've posted that here on Twitter, but what the study did was look at the year-over-year percent change in U6, which is what we have in blue here on this chart. And then what I've also done is I've looked at the year-over-year percent change in the NASDAQ. And essentially, what this shows is that as the U6 unemployment rate starts to accelerate higher and get above zero on a year-over-year basis and continues to trend above zero, we typically enter into a recession. And during that period, stocks like the NASDAQ Composite Index in this particular example tend to roll to the downside. And so that's exactly what this chart is showing, is that as U6 unemployment is rising through here, we see the NASDAQ also falling. Now you could maybe point out that this is the dot-com bubble, which was largely caused, the recession was largely caused by the pullback in the stock market. But if we look at 2008, we basically see the same thing. We basically see in 2007 that the U6 year-over-year unemployment change becomes positive, is above zero, and continues to accelerate higher, at which point the NASDAQ starts to turn lower. We've been in basically a Goldilocks period where the year-over-year percent change in the U6 unemployment has remained below zero for basically this is like 8 or 9 years here, but then we got the massive COVID spike, which was a very unique situation due to lockdowns and exogenous variables, if you will. But even still, we saw a massive acceleration here in U6 unemployment and a massive downturn, albeit a brief downturn, in the NASDAQ Composite. Recall the max drawdown from the 52-week highs for the NASDAQ Composite was, if my memory serves me correct, about 30 to 35% to the downside. And so essentially what I'm trying to show here is that while we may not be in a recession yet, or we may be in a recession now, we really don't know. We only get confirmation of that until after the fact. But what we do know for certain is that the labor market, which is a lagging indicator, has yet to see a substantial deterioration, which would be congruent with a recession. Therefore, based on how this dynamic has typically played out in the past, we would expect to see a further downtrend in the year-over-year change in the NASDAQ Composite Index, likely below this negative 40% level. Now, I'm not sure exactly if we'll get to that 40% level, but I would certainly expect us to trend in that direction. Now, I just want to be sure to say that this is not a decline from 52-week highs. This is a year-over-year percent change in the NASDAQ Composite. So as of today, I believe the NASDAQ Composite is down about 25% from the 52-week highs. However, this chart here is only showing us that the NASDAQ is down maybe 10% on a year-over-year basis. So in my opinion, this is essentially forecasting more potential pain down the line that investors should essentially be prepared for if we do see a material deterioration in the economy going forward. Like I said, whether or not we're in a recession right now is certainly up for debate. We don't know. But what we do know for certain is that we haven't seen a deterioration in the labor market that would be congruent with a traditional recession. Therefore, if we do start to see a deterioration in the labor market, in the labor market, not only would that be congruent with what we would see in a traditional recession, but it would also help us to set our expectations for more downside ahead in traditional equity markets. Clearly, we're obviously talking about tech here by looking at the NASDAQ composite. But even still, right, we would expect to generally see pain in the equity markets if we did continue to see, I don't want to say continue to see, because I would actually argue, on a year-over-year basis, as of today, right, the U6 unemployment is down, let's just say 30% year over year. So this is really trending in a very strong direction right now. Like I'm saying, we haven't seen a material deterioration in the labor market yet. But if we did start to see a rise and getting back above 0% and then a continued trend into positive territory, that would be very concerning, in my opinion, for what could be in store for equity markets. So that's the first set of bad news. Because we haven't seen a material deterioration in the labor market, and if the economy is continuing to trend towards a recession or deeper into a recession, then we would expect to see this get much worse. Therefore, we would expect to see stocks perform much worse on a year-over-year basis, essentially hinting towards more downside ahead. Okay, that's the bad news. And I hate to sound doom and gloom because I wouldn't necessarily categorize myself as doom and gloom. I'm still extremely long-term bullish on stocks and Bitcoin and even Ethereum on a long-term basis. However, we must acknowledge that there might still be short-term pain and short-term consolidation periods that are still yet to be had. So this really does kind of fit within my overwhelming thesis that I think investors should continue to be patient in this environment. There's certainly a lot of uncertainty in the markets right now. So as we continue to kind of navigate this uncertain economic environment, and as talk of a recession continues to heat up, we'll be getting the Q2 GDP print later this week. I'm recording this on Tuesday evening, July 26th. But if we do start to see the traditional definition of a recession, which is 2 consecutive quarters of negative real GDP growth, then as we embark further into that environment, potentially, I want to be patient as an investor and allocating on behalf of others for their long-term portfolios. Okay, with that said though, I do want to switch over to some positive information because I did produce a study and conducted a study yesterday evening that I was extremely, extremely surprised to see and very optimistic to see this data. And I wanted to go over this with everybody today. I did post this on Twitter. I'll leave a link to that in the bio so that you can get more of this information in writing. But very quickly, what we're looking at here is the NASDAQ 100 index with monthly candles, basically as far back as I can get the data going back to 1985. In the lower bound here, what I've added is the Williams % R oscillator over an 18-month period. So we're looking at this on a 1.5 year basis to identify overbought and oversold levels. And in particular, right now, we're in an oversold level. But more specifically, as we look down here at the bottom right, we can see that we're trying to make an attempt out of this oversold level for the month of July. Obviously, there's still a couple of days left in the trading month for us to see how this shakes out. So it may or may not happen for the month of July. However, it could be setting us up for the month of August or, sometime in the near future. Let's just see how things shake out. But either way, this is a very intriguing signal because it's only happened 4 other times since 1987. So when we look back at these periods, by the way, this is in logarithmic scale. If we switch this into linear, it looks much different. So this helps us to really contextualize the price action from a historical perspective. So if we look generally speaking at these periods, we can see that generally they tend to align with a bottom of the market. And so what I ended up doing is I went ahead and I put together the forward-looking returns for the NASDAQ 100 after this signal gets produced. So for example, if we look at this signal right here occurred for the month of November 1990. So if an investor had bought the open in December of 1990, here's how they would have performed. So in that particular example, we're looking right here at this row. And so 3 months later, the NASDAQ composite was up 30%. 6 months later, up 45%. 1 year later, up 48%, so on and so forth. And so I did that for each of these individual cases. Clearly, this is a very small sample size. Like I said, only 4 prior signals have happened since 1987. However, we can see that in each of those 4 prior signals, the bottom in the market was already in once this signal flashed. So this has been an excellent signal in the past that stocks have bottomed and are prepared to move higher in the short, medium, and long term. We can see here in November of 2002 that the index still fell about 10% after the signal was produced. However, it's important to note that the NASDAQ didn't make new lows. Okay, it just fell about 10% after the signal was put in, but we didn't create new lows. Either way, we can see here that the 1 year average return is basically up 32%. 2 years up 60%, 3 years up 67.5%, 5 years up 155%. So an investor who bought this signal in the 4 prior instances had an average return of 2.5x their initial investment over a 5-year period. This is phenomenal data. This is extremely strong data indicating strong market returns going forward. I want to highlight that in each of these 3-month periods, stocks either rallied or fell about double-digit percents, right? We had up 11, up 30, down 10, up 15. So this essentially tells us to expect short-term volatility over the next 3 months. I didn't calculate the 1-month returns, but I might have actually been interested in taking a quick look at that just to generally see how stocks behaved immediately after the signal was put in. Either way, we could generally see a very strong and consistent picture with these 4 signals. Again, small sample size, but still a meaningful signal that can help us to set some baseline expectations for what the market may do going forward if and when we put in this confirmation signal. Again, I want to highlight that what we're looking at here is when the Williams % R oscillator becomes oversold, so it falls below this negative 80% threshold, this lower bound white line, and starts to get back above it, right? So in each of these instances, we came back above, we came back above, we came back above right here, we came back above. So this kind of, you could potentially call this somewhat of a momentum thrust or reversal, if you will, from a statistical perspective in terms of the underlying asset being oversold and being no longer oversold. So this is a very strong indication for us to monitor going forward. Again, we don't know for certain if we're going to get it for the month of July. If we kind of zoom in here on this price action, let's just expand this, we could still see we're below that negative 80% threshold. So we would need to see a substantial market rally, maybe of 3 to 6% for the remainder of this week, which would close out the month of July, if my math is correct. So either way, though, what this is showing is a bullish signal could be very close around the corner. Whether or not that happens right now for the month of July, we're not quite sure. One thing that I would like to point out when I posted this data is that someone had said and essentially warned, well, hey, Caleb, we could be at this month here in January of 2001. And it certainly looks like similar price action to what we're seeing in the market right now, right? We're seeing this massive decline, a potential thrust higher, but unable to complete the signal, and then a big decline thereafter. So we could be setting up for that right now in the current market environment. We just need to see how this plays out. We don't know yet, but part of being a technician and an analyst and looking at these different data points is understanding how the market may evolve if and when something occurs. So if XYZ, then ABC. And that's essentially what we're doing here. So again, these are 2 totally different types of views on the market. One that is very macro focused, looking at the unemployment picture, potential recession indicators, and things of that nature, and therefore how the market may behave thereafter, versus something like a complete statistical indicator, something that's totally removed from the macro framework and things of that nature and purely focused on a statistical or quantitative study, right? So it's extremely important to note the stock market does not, and the entire asset markets do not operate in a vacuum. A lot of these different themes and market factors and economic fundamentals are all intertwined. So it's important to look at these different statistical studies and recognize them for what they are, and recognize that, hey, this could be a bullish indication. But we can't take this as like some set in stone or guaranteed development, right? We need to see how this evolves. But at the very least, right now, we can potentially be a little bit optimistic with this particular data point. So it's up to each investor to basically digest this information and think about how it fits within their worldview, their expectations for the market and the economy going forward. But either way, I wanted to share this with everybody today. If you're not already, I've already shown both of these studies and explained them on Twitter. So if you're not following me there, you're seeing this data a little bit late. So check me out on Twitter at Caleb Franzen. I'll leave a link down in the bio. And I'll also be potentially reviewing some of this stuff in this weekend's free edition of Cubic Analytics on Substack. So if you're not signed up for my macro newsletter, be sure to check that out as well. Cheers, everyone. Take care.